All right, the top three creative finance strategies to acquire a multifamily property. Look, if you think you need a ton of cash or perfect credit to buy apartments, I want you to think again. These three strategies have helped investors close deals with little or none of their own money. So let's dive in and talk about these strategies. The first strategy I want to talk to you about is seller financing. And really, it's instead of going to a bank, you simply become the lender, or excuse me, the seller becomes the lender, and you negotiate directly with them for the interest rate, the amortization, the payment schedule, the down payment, all are on the table. They act as a bank. And when it works is when properties are owned free and clear, you have sellers that are looking for steady monthly income instead of a lump sum, off market deals, and tired landlords. These are all people that are retiring to Florida. These are folks that have owned properties for years and they've used up all the depreciation. There's no tax benefit for them to hang on to these properties. So we find a situation where they are willing to take back paper, they call it. And it's powerful. I mean, you skip traditional financing hurdles. You got no bank, no underwriting, no appraisals. You set the terms together. As long as they work for the two of you, the deal can usually be had at a lower interest rate so that you can pay them a higher price, frankly, because currently, with the way deals are working at the higher interest rate levels, we're not seeing deals work quite as well as they used to. So often offering a lower interest rate than current market rates allows you to pay them a higher price, which allows you to often grab a deal. So I'm going to give you an example that I'm working on. I've got a property I'm working on. I've got 5% interest only for 5 years, a 75% loan to value, and I'm talking about a $4 million loan from this seller. And it's going to cash flow amazing because I've put this debt in place. Another strategy, which is interesting and more prevalent these days because of what's been going on with interest rates and so forth, is the assumable debt. And what this is, you take over a seller's existing mortgage. Now, usually these are Fannie or Freddie loans because those are the ones that allow for assuming debt most often. And you lock in their low interest rate and you get better loan terms from a prior market cycle. Same strategy. You're looking to capture lower interest rates by assuming someone's debt. These are fixed rate loans. They usually were originated between 20 and 22. Properties that are strong and they have strong in-place financing, and sellers are open to a smooth transition. Often it saves them a lot of money, or in some cases, a really large prepayment penalty if they close out that loan because they might have chosen yield maintenance for a Fannie or Freddie loan. That's a conversation for another day. But why this is so powerful, you again sidestep today's higher rates, you really reduce the closing costs, and you keep monthly payments lower. It boosts your cash flow and your returns overall. I've done a 9-unit deal here recently, and I assumed a low rate debt. There were 7 years left on it, and then raised the capital, the equity to cover the down payment, and closed the deal with better financing than I could have gotten out in the market today. So definitely a strategy that you can use in order to, again, lock in lower interest rates and get a better deal than you'd get by using standard, typical financing in the market. And then strategy 3 now is more on the equity side. The first two were on the debt side. You source a deal and you assemble investors to fund that equity. You become the general partner and your investors become the limited partners or JV partners, depending on the structure. But when this works best is larger deals, often with value add opportunities, but not always. Their cash flowing really helps a lot because it's an easier deal to sell and to attract LP investors. You've got a network or a reputation where folks who trust you will invest with you alongside you for some very great returns that you expect from your deal you're projecting. And if your strength is in finding and operating deals, not raising all the capital by yourself, it really helps as well to be able to do this kind of a structure. And it's very powerful. You can control an asset, earn equity without even being involved in the deal from the standpoint of investing your own capital. You get paid for your knowledge, your hustle, your execution, not just your checkbook. And I've syndicated a property that was acquired at $3.5 million, 24 units. And between the lender financing, which is other people's money, and the investor capital in the syndication, I acquired the deal, structured the financing, led the operations, and the investors funded the equity and have shared in the returns. So it's a great way to obviously acquire a deal as well. And it's less impacted by the debt rates that you can achieve. You're often acquiring these properties at current market rates with a lender, but you can sometimes do both. Get, let's say, seller financing and syndicated deal. And those deals are true other people's money deals. So, creative financing is not just about being clever for the sake of it. It's really a process of solving problems for sellers, lenders, and investors. These are tools that unlock opportunities that others overlook. In fact, often the way I approach this is by underwriting a deal based on current rates. Okay, and especially if you have a seller that really wants a low cap rate for his deal, and if I can underwrite that deal and show him where the deal actually cash flows and debt services at like 125, you can find that you can make it clear to him that the price he wants is really just too high, and compare that side by side with a seller financing option, for example, and a higher price, and then you add in, if it's 5 years of interest only, you add in as a total the purchase price, a higher price than he'd get with bank financing, and you add the interest over 5 years. Often he surpasses what he even asked for just by taking seller financing, waiting a little bit longer to get those returns. So this is an exciting way for you to acquire properties. You have to know what to look for. You have to go and find investors, sellers that are ready to retire, let's say, own a property outright, don't need all the cash, don't want to pay all the capital gains all at one time, and will accept seller financing or a loan you can assume or something along those lines, and it can create some great opportunities for you. So let's call it a day on this program. These are the kind of things that we look for when we're finding deals. And just remember, it's all in the numbers.